Sorry about that.
That's okay.
All right, so where was I? Anyway, with the calls, my strategy is since Neo's been so bullish, I don't pretend to know what the price will be in a month or 2 months or
Yeah,
3 months.
I know.
So what I do is I take the most conservative approach and go, okay, I'm not going to go more than 30 days out on any calls. And I'm always going to shoot for the highest strike possible. So whatever it is right now, $100, that's what I'm going to do. But I'm going to put up all my shares.
You do. You throw out all your shares, huh?
Yep.
And okay, let's say worst case scenario, like I'm looking at February 12th, right? Like at the $100 strike price is 23 cents. So that's if I were to sell all of my shares in my Robinhood account, it's like 4,000. So 4,000 divided by 100 is what, 40?
Yeah, so 4,000 times 23 cents, that's how much you get.
That's amazing. And you get to keep that money, huh?
Yeah, you get the money right away.
And let's say that on February 12th, that money went to that, or that the stock price went above $100 on February 12th.
Yeah, that I'm okay with just getting $100. That's a
But
risk I take.
and what
I think
happens if someone ended up buying that? You lose all your shares?
you sell your shares at 100, so you get 4,000 times 100, or whatever, how many shares, or whatever
Oh.
amount of shares you put up.
Oh,
So
okay.
I'm good with getting 100. I'm okay. I think like I said, I think the most conservative approach. I think the chances of my calls being in the money are a lot, like somewhere between 1% and 3%, because the time horizon and the calls are so out of the money that I think it's very low chance. And so far, my shares haven't been exercised, not once. So it's
Yeah.
just been free money. That's the approach I take. And also, I don't sell any calls right before earnings day, NIO day, or deliveries. But I will sell on either deliveries or earnings if I gauge what I hear and see, depending on like the earnings call or the delivery report. Let's say we spiked up 10%. Let's say we go up to like $66 on the delivery report. I'll probably still sell calls that are like I'm 30 days out and sell on that day that the delivery report, because when it spikes 10%, the calls are going to go up maybe 30, 40, 50% on that day. That's the day you want to sell.
So
So I
like
won't
today,
sell.
like for instance, today,
Yeah. Yeah, go ahead.
today would have been a good day to sell, huh?
No, it was a good update, but I'm waiting for, and people might front run the delivery numbers. That I'm thinking might happen because there's a lot of rumors that they're going to be at 8,000. If I see a 10% movement between now and deliveries, up until the day of deliveries, I'll sell calls on that delivery. Now I'll go not more than 30 days out.
And what's the reasoning behind that? What's the reasoning behind that?
When you sell on a big green day, that's when you get to rake in the most premium. The premium on the calls goes
Oh,
way
because the
up.
premium goes up. Yeah. Okay.
Right.
So
So I
like,
won't sell before deliveries unless there's like a 10% spike. But if it's getting close to deliveries or at deliveries, then I'll sell, but I won't go more than 30 days sell.
okay. And now let me see this. Like, So if I click on here, so I'm looking at February 19th, $100 strike price, and I'm looking at the volume and the open interest. So like, I mean, there's 1778 volume and open interest is 2379. The chances of me selling all 40 contracts is high or no?
I think you got. I mean, people say you got to look at implied volatility. I think
That's at 99.52. You want it high or you want it low?
Yeah, when it's high, people are saying that you get a pretty good premium. You get like a really nice premium when it's at 100 or more. But there's and I'll send you the link. There's this site that shows you the probability. Let me just pull it up. Of whether they do it on some kind of formula that they derive from somewhere. I don't know what exactly, but it shows what the likelihood of that hitting the money. So let me bring it up. Okay, so let me go to the February. Let's just put it at February 19th call. Yeah, they call it the delta.
Yeah, delta. Okay.
So let me just send you the. Oh, am I able to send you links?
Just send it on. You can send it on Facebook Messenger.
Oh, okay. Okay, got it. All right. I never used this call feature. But anyway, this is the one. I just sent you the link I'm looking at, and it's through MarketBeat. That's the one I go to look at stuff. But you look at the $100 one, and the delta is like 4%. So there's a 4% chance that it's going to be in the money, and you're going to be selling the $100. You're going to be selling your shares for $100.
This one says the delta is 0.001, so that's like 0.1%.
0.1. I'm looking at it. It says 0.04. Are you looking at the $100? 19?
Oh, I'm looking at January 22nd. Hold on.
Okay, it must have defaulted the.
Oh, let me switch it. Yeah, let me switch it.
They switched it up back to the.
You have 219. Yeah, 0.4. Okay, so a 4% chance.
Yeah, so it's a 4. I'm willing to take the risk. 4% chance, 96% chance. I don't sell my shares, and if I do sell, I mean, that's 8.6 million for me. So I don't think. Yeah, do I need anything else?
Yeah, that's great.
Yeah, right. It's like it's a win-win.
Yeah, if it was at 100 for me, I think that's like 1.3 million. No, more than that. It's like something like that. Let's see. Yeah, 1.2.
Okay. Anyway, so that it tells you this is the 4% chance. But like I said, I only sell on like big green days. If I see a 10% spike, then I know I'm getting the most premium price for my risk.
Yeah. Now, when you go to MarketBeat, what do you click? You click on options chain. That's what you click on. Options chain is the same thing.
I just pick the date, and then I click options type, and then by default it'll put the calls, but you can just do calls just to show the calls only.
Yeah, I was just looking at another. So I own a lot of IDEX, but I don't think that I would start selling IDEX now because the calls it's only up to $6. I don't know if you're in. I don't know if you're into that, but the NIO is a more safe bet with $100. Yeah, at 4%. Like I'm looking at IDEX for February 19th. That's at a 17%. but I would make more money, I think, just holding on to the shares if it went that high.
Right.
Well, this is a whole nother stream of income that I was unaware of, because I'm willing to take, that I can sell my other ones. Can I do this in Fidelity or no?
Yeah, definitely you can do it in Fidelity. I don't have Fidelity, but I know people that do, and they definitely can. You just have to be approved for options. You just have to send a form or something through their
that
app.
could be like an extra $5,000 a month. I don't even need a job anymore if I'm just taking the premium. Now, what about taxes? You're gonna have to pay taxes on that, right?
I'm assuming you do. I've only started doing this, like I said, a few months ago. So I haven't filed my taxes for 2020 yet. So I don't know. I just give, and I haven't even got all the tax forms from my broker. Yeah. I'm on both Merrill and Schwab. With Merrill, I'm on my IRA, and Schwab is my regular cash account. But anyway, I'm just going to download whatever they put on my account and give it to my tax guy, and we'll see what happens. But I'm assuming if it's income, you got to pay tax on it.
Yeah, of course. You're gonna have to pay taxes on it, but this is basically like leveraging my shares to. I don't understand how people don't know about this. I didn't know that I could do this.
Listen, I held stocks for years and years, and I had no clue either. And so one of my friends on Facebook gave me an education about this, and then I looked into it. I did my research, and I'm like, why am I not doing this? This is like free money.
Yeah, it basically is. It's just leveraging. It's leveraging your leverage that you have.
Right. They want your shares, so you're selling people hope, is what it is.
Yeah, that's what it is. And you're the bank.
They can get your shares.
Yeah, because like when I buy options, sometimes I'll just buy the $100 one. I know that it's not going to get to 100, but if it goes up, I can get rid of it and still make a little bit of money from it.
Right. So a lot of people do that. They buy the $100 option because they just want to, they want to buy.
It's a small barrier to entry, right?
They want to. They think, oh, it might go up 50%. I'll dump it if it goes up 50%, 30%, whatever. You know what I mean?
Yeah.
So they're not necessarily going to think it's going to be in the money to get the shares, but they're just betting that it's going to go up to get whatever percentage they think they can get out of it.
Now, if they sell, like let's say someone buys that 100 call option that we are selling on February 19th for this example, and let's say it goes to 80, right? So now the strike price is, I'm just going to make this up, it's 72 cents. So, or like it's more, right now this one says 36 cents. And they sell it at like, let's just say 52 cents. I'm just making up a number. They're going to make a little bit of money off of that from somewhere. Where does that money come from?
I don't know. It's like, how does a stock go up? It's the same thing. The calls are just a derivative of the underlying shares. So, when people bid up the price, when more people want the shares, it bids up the price, the share price goes higher. Same thing with the calls. When more people want them, they bid up the price. More people want those calls, and they go up higher. But with the calls, they're more volatile, and if the share price goes up, it's like kind of like a seesaw, and the calls are at the end of that seesaw, and it'll go up or down by like a factor of like 2, 3, even 4 times than what the share price will go up. So it's a leverage play, but you could lose your whole investment also.
Yeah, you could, right? I guess, but I would take that 4% risk. Now,
right? Me too.
Because I could. So this is the other thing. So when I asked you about the wheel strategy, So what you can do is what I saw on YouTube is that you can sell the current call that you're in and just sell it for a further day out. And then you just you lose a little bit of money, but you get to keep your shares, because if the stock price comes back down, then it doesn't close at that on the later date. So it's better to do it like either every week or every month, rather than do it like 4 or 5 months out, because then your capital is stuck. Then your capital is tied up for that long. So, or like your collateral, I guess, not your like your collateral, like your shares.
Right.
So
what I've been doing, what I've been doing with puts, that's a totally different animal. But with the puts, because the premium I've been getting for those are a lot higher than the calls, because they're much. I've been selling those a lot closer to the money, because I don't mind owning the stock
for cheaper.
You know what I mean? So like I've been selling the $49 strike for the puts and getting like $2.50 per share. But as soon as the price goes down 50 to 75% on the price, I buy back my puts and sell something else. Sell puts like another 3 weeks or a month out. So I'll buy it back early just so I can close out the position because I made enough, and then go on another 2-3 weeks and burn it out. So that's what I've been doing with puts.
Yeah, that's so cool. So so come February 19th, you just rinse and repeat. So if I get these premiums for, if I sell 120 contracts, I mean, that's a lot of money just for the month.
Yeah, 120 contracts is 12,000 shares worth.
Yeah, and that's 12,000 shares. That's more money than I was making at my regular job.
Oh yeah, I'm making 4 times as much money that I made at any job I had. Just doing it.
It's just because we got in so early. Now we have the shares, right?
Yeah, now everybody wants shares, but the shares are like 30 times what they used to be. So the option premium and the option prices, everything goes up by that much, by 30-fold.
That's amazing. That is, I mean, I've been sitting here for months not knowing this. I could have been doing this.
I'm in the same boat as you. I held Apple for 10 years. I sat on it, and I didn't know I could make money on my shares. I had no clue.
And you could have made so much money from that.
I know, but did I know information is key in this world. The more information you have, the better off you are.
Wow.
Now, at least we know now, right?
Yeah, I'm going to start doing this. I mean, I would like to communicate with you back and forth and kind of figure out a good tactic. Like when you're selling them, I'll hit the send key. Like, you have more experience by a couple months than I do, and it is what it is. But the other one I have is the IDX. I'm going to wait until that goes up, and then I'm going to start doing it with that.
So what I've been doing, I already told you, I'm selling like no more than 30 days out. I'm not doing it before earnings, NIO day, or deliveries, but I'll do it on the day if I get enough spike off the price.
So like today's January 22nd. You have all of yours already out there right now until the close date?
Well, I have 860 contracts expiring next Friday. I sold. I made like 28 cents, I think, or maybe 30 cents. Now it went all the way down to like 1.5 cents. So it's crazy. I made like 95% return on my options already. I could close it out early and see if I saw another strike. Let's say I wanted to sell once right now, going out another month. I could close out my position early by buying back my calls and go out another month. But I don't want to do that until the delivery's date. So I'm
Yeah.
just going to let them expire. You could either let them expire or buy back early if you want to initiate another trade to go into something right now that's going to be more lucrative, is what I'm saying.
Yeah. So let me ask you this. Today, I just was messing around with this. I had 129 January 29th, $67 calls. I sold 2 of them. And
Okay.
in my this one is on Robinhood. In my Robinhood, it says that I'm losing money on it. Like I'm negative $196. But the price is not at $67 yet, the share price. So if it expires less than 67, one, I don't sell those 200 shares, and 2, I got to keep the premium of $108, right?
Right. It'll just, because you're so close to the money, it'll show that you're negative because the options probably went up in price.
Yeah, they did.
You know what I mean? Because you're so close to the money. But if you don't hit that 60, they expire next Friday, right?
Uh-huh.
So if you don't hit 67 by next Friday, they'll just expire worthless. No matter what, how high the options are trading at. If they're under that 67 strike by next Friday, they're still going to expire worthless. So
Well,
it doesn't
hopefully
matter.
they don't make it to 67. I'm looking at this. Let me see this
Right.
options chain thing. Options chain for 129 at 67. It says the delta is 80%, so hopefully that's not gonna go through.
Yeah, I mean, I can't tell you one way or another. I mean, it might be, but there's a good chance that it does hit the bunnies.
Oh, I'm looking at the wrong thing. No, it's 13%. I was looking at the implied volatility.
Okay. Yeah, look at the delta.
Yeah.
Okay, so it's 13%? Okay, then it's 13%. It is what it is.
Yeah. Yeah. Wow, this is amazing. This is pretty cool.
So another thing that I'm doing, so like I've been collecting money on this premium, and then as soon as I collect the money on the premium, I get a nice pool of money together, and then I sell the puts on that, and I make even more money on that. So let's say I collected $40,000. Let's say just collect $40,000, and it's just sitting on the side in my cash balance. I'll go ahead and sell a commensurate amount of puts for that $40,000. So let's say I'm selling, let's say, the $40 strike for a month out or whatever. I can sell 40,000 shares worth and get, if I'm collecting, let's say, $1 a share, that's $1,000 right there. I can make extra just on that. So you can make your money on your shares, but you can also make money on the cash. Let's say if you have excess cash, you can tie up that cash for, let's say, 3 weeks or a month and make an extra money on that too.
That's awesome.
Yeah.
That's insane.
That's what I've been doing. So it's kind of like,
you know how they say like you can't have your cake and eat it too?
Yeah.
This is actually the opposite. You can have your cake and eat it too.
You just have to be smart. You can't, like you said, don't go out too far. Don't go out more than a couple months because we don't know. Things are moving fast. Things are changing fast. Look at all the upgrades. Now we have $100 upgrade by this one house.
It's I know who you're talking about. I don't remember. It starts with a D, like
Daiwa.
Yeah.
Daiwa Securities. Yeah, $100 target. Did people see that 2 months ago? No. So things change fast. That's why I'm not willing to go out more than 30 days.
Yeah.
You just have to be smart about it, I think. And then you can make money and not really put a lot of risk into your that your shares will be called.
Yeah. All right. Well, so I guess I'm probably gonna wait. When deliveries are probably gonna come out for NIO like February 1st or 2nd. I don't know what day February 1st or 2nd is, but so after that is probably when I should maybe sell all these contracts. Because
So I have a feeling, because there's a lot of rumors that people already know about, that it's going to be over 8,000, that they might front run that. They might front run the deliveries report and make it spike before. So you got to look at the price next week. If you see like a big spike of, let's say, 8 or 10%, I'd sell your calls on that day, even if it's before deliveries.
And that's because the strike price is going to be higher and I'm going to get more for my money. And then when it goes down, I still get to keep the premium, right?
Right.
Yeah.
So let's say we get a spike of, let's say, 8% or maybe 10% this week. You sell on that day, you might get a 30% jump on that on the call premium, just because you sold on that particular day.
Yeah, I need to call Fidelity and get them to turn my options trading on.
Yeah. So and if you're going to sell puts, it's exactly the opposite. If you get a big red day, that's when you want to sell puts, because you get the premium goes up on the puts when you get a big red day.
And you're selling the puts within a month at the furthest number out. Like the lowest
No,
number?
not the furthest number out, because I don't mind owning more shares. This is what I'm doing. I'm going no more than $10 below the current share price. So let's say the share price right now is 62. I'll go to 52 or 52 strike on the puts.
But then you have to have okay, so 52. So I'm looking at 52. So well, what's your expiry date? Which one are you thinking about?
Let's say I go a month out. A month out is what, February 19th?
Yeah, February 19th.
February 19th. So let me go to puts.
On 52, right. That's $1.77.
Yeah, $1. There you go, $1.77. So let's say, I don't know how much cash you have. Let's say you have enough for 1,000 shares. You get $1.70 times 1,000. That's $1,700 you make extra. And if it does get into the money by that day, you're just buying more shares more cheaply.
Yeah, that's amazing.
So that's my philosophy. That's what I'm doing. With the calls, I'm more conservative because I don't want my shares exercised. But I don't mind if my puts get exercised. I really don't.
Yeah, because then you just get more at a cheaper price, and that's guaranteed money because it's going up.
Right. So I don't mind getting more shares at a cheaper price, especially when the money I'm using was generated by selling calls. So it's the casino's money.
Okay, so that's the wheel strategy. That's exactly what that is. Now I understand it.
Is that the wheel strategy? I don't know. I just made it up on my own.
Yeah.
I don't know if it's an existing strategy or not. I have no idea.
That's what it is, except they do it the other way. They sell the puts first, and then they do the calls.
Oh, I see. See, I don't have the money to sell the puts until I generate money selling calls, because I already have the shares.
Exactly. So what they were doing is they didn't even have the shares, and they were selling the puts, and then they were selling the calls because it goes up and down. So, yeah.
Yeah. Since we already have the shares, we got to do the opposite.
That's awesome.
Yeah. So that's my strategy. You don't have to follow it.
Well, it's working, so I'm gonna follow it, David. I'm not here to reinvent the wheel. If it's working, it's working.
Right? Like, don't you agree? Be as conservative as you can.
Yeah. And this morning when I sold the 67, I was like, there's no way that it's going to be at 67. But I mean, and then I bought a 67 sell a 67, and I bought a 59 call this morning, and I was just messing around. I really don't. I don't like. I mean, I buy calls. I don't buy calls. I lose money on the calls. I make money on the calls. It's just up and down. I don't really have a proper strategy for it. But I mean, today would have been a great day to hold that $59 call because I had two of them and I would have made a bunch of money off that. But
Right.
I'd rather.
I don't want to ever buy calls or puts. I always want to be a seller.
Yeah, it makes sense. You're leveraging your leverage.
Right. You got the shares, so what they say, what the golden rule is. Who has the gold makes the rules. So we got the gold, we got the shares, we make the rules.
Exactly.
Other people are trying to get our shares, whatever. So we have all the power.
Yeah, this is amazing. This is a whole different way of the stock market for me. I didn't know this.
Yeah, I didn't know this until literally 4 months ago. I had no idea. I was like, what the hell is that? I don't want to get into that. That sounds complicated.
Yeah.
It sounds risky, blah, blah, blah. And then my friend taught me, he just went into detail on it, and I'm like, this is not hard.
Yeah.
I can get into this. Yeah.
Wow, that's amazing.
Yeah, it is amazing.
Well, that's good. So how's everything else going with you?
Oh, it's doing okay.